Here with us, but let's go across to the management. SBI conducting a press conference post the Q4FY25 earnings, beating expectations. Let's listen in to what the management has to say.
Ram Mohan Rao Amrasar, along with our DMD Finance, Madam Saloni Narayan. I also extend a warm welcome to other DMDs and senior officials of SBI who are present with us this afternoon. We sincerely appreciate your presence at the conference. I now request our chairman, Sethi sir, to address the media and present an overview of SBI financial performance for FY25 as well as Q4 FY25. Over to you, sir.
Good afternoon, ladies and gentlemen. We thank you for your interest in SBI and taking the time out to join the press meet today, post announcement of financial year 2025 results of the bank. Results for the year FY25 highlight continuity, consistency, profitability, and SBI's significant long-term strengths. So I would like to start by thanking all of our stakeholders, including our customers, shareholders, employees, and the broader ecosystem for their support and helping us in creating sustainable value for the economy. Let me first start with a brief description of the present global and domestic economic scenario. Escalation of trade and tariff tensions and the resultant financial market volatility have raised concerns regarding the weakening of global growth in the near term. As per IMF, the estimated global growth is projected to drop to 2.8% in 2025 and 3% in 2026, much below the historical, that is 2000 to 2019, average of 3.7%. As per WTO, world merchandise trade volumes could expand marginally by around 1.7% in 2025. The dampening global economic outlook could impact India's economic growth through weaker external demand, even though the domestic growth engines, consumption and investment are relatively less susceptible to external headwinds. Prospects for the farm sector have been boosted by the forecast of an above-normal southwest monsoon for 2025, which would augment farm incomes and keep food prices under check. Given the exacerbated uncertainties due to recent trade tariffs, RBI has reduced its real GDP growth projection for FY26 by 20 basis points to 6.3% in the April policy. Separately, India's CPI headline inflation has now significantly moderated, and we believe average CPI headline forecast for FY26 could stay below 4% now. During FY25, ASCB's credit growth declined to 11%. It was 20% last year, and deposits to 10.3%. It was last year 13.5%. Term deposits growth continued to outpace growth in savings deposits. Consequently, the share of term deposits in total deposits rose to 62%. CASA declined to below 40%. Asset quality of SCBs improved further, with their GNPA ratio declining to a 14-year low of 2.4% in December 2024. CRAR stood at 16.4% in December, which was much higher than the regulatory minimum ratio. RBI has deployed a strategic mix of interventions, including open market operations, daily variable rate repos, and dollar-rupee swaps. These proactive measures have helped stabilize market liquidity conditions, ensuring financial resilience in an unpredictable global environment. Coming to SBI, the results for the FY25 demonstrate the bank's ability to operate profitably at scale due to our substantial long-term strengths. These advantages stem from our institutionalized framework, which is guided by structured processes and commitment to fairness for all stakeholders. The net profit for the year was 70,901 crores, up 16.08% year-on-year. At the end of FY25, our whole bank credit growth was 12.03% year-on-year, with the domestic credit growth at 11.56%. Deposit growth was 9.48% year-on-year, while the CD ratio was 69.71%. We maintained stellar asset quality with slippage ratio of 0.55%, retail personal slippage ratio at 0.48%, credit cost at 0.38%, and PCR at 74.42%. On the deposit front, at the end of FY25, deposits have crossed 53 trillion with a customer base of more than 52 crores. Our bank is privileged to serve 1 out of every 3 Indians, and in some way, SBI touches every Indian family. The total deposits have grown by 9.48% year-on-year to 53.82 trillion. Term deposits have grown, as I said, the higher than is savings by 11.48% year-on-year. And our current account deposits have grown by 27% year-on-year. And CASA deposits have grown by 6.34% year-on-year. And the CASA ratio stood at 39.97%. I'm glad to share that the credit growth continues to be good across all segments, though there is some moderation. Our domestic credit has grown by 11.56% year-on-year, driven by 16.86% growth in SME, 14.29% in agriculture, 9% in corporate, and 11.4% in retail personal segments. Our foreign offices advances have grown by 14.84% year-on-year. The domestic credit deposit ratio is 69.71% at the end of FY25, indicating sufficient headroom to address future growth requirements of the economy. The bank continues to demonstrate industry-leading asset quality at this scale. The slippage ratio for FY25 was 0.55%, while the credit costs stood at 0.38%. The net NPA ratio improved by 10 basis points and stands at 0.47%. We have a well-provided NPA book with a PCR at 74.42%. The asset quality of the bank has continued to remain strong over the last 5 years, which demonstrate the quality of our loan portfolio, the robustness of our underwriting processes, effective collection efficiency, and the leadership of the bank across business lines. Our capital adequacy ratio is at 14.25%, and the CET1 ratio is at 10.81%, are well above the regulatory requirement. Based on the current profitability and growth profile of the bank, we believe we have sufficient headroom to take care of business growth requirements. I'm happy to share the progress we are making in digital banking. More than 8.77 crore customers have registered on YONO, which is pushing forward the digital agenda of the bank. 64% of our regular savings bank accounts are opened through YONO in FY25. Our subsidiaries are consistently performing well and continue to create significant value for all the stakeholders. We will continue to nurture these subsidiaries and maintain leadership position in the respective businesses. We are glad to report that the bank continues to report ROA and ROE greater than 1% and 19% respectively at the end of FY25. While we are glad about the outcomes in FY25, we are also mindful of areas for further improvement and the challenges emerging from various developments taking place across the globe, which may impact Indian economy. On the liabilities side, we continue to focus on increasing our share, our leadership in current account while maintaining the leadership position in savings deposit by further strengthening our customer service and branch network. Although the bank's cost base is substantial, it highlights our commitment to compliance and efficient operations. From this strong position, our goal is to consistently achieve an ROE over 15% through the business cycles. The board has granted approval to raise equity capital up to 25,000 crores, with the authorization being valid for a period of 12 months. This is an enabling resolution. Although we are open to capital raising, such plans will be contingent upon the business needs and market conditions. Wrapping up my initial comments, I express my gratitude for your ongoing support to the bank. As the bank advances its objectives, it also plays a role in driving the progress and economic development of the surrounding ecosystem. We are dedicated to upholding your confidence in us by delivering superior, sustainable returns over the long run. My team and I are now open to taking your questions. Thank you very much.
Thank you so much, sir. We will now move on to media question and answers. To ensure a smooth and orderly session, we will take questions in sequential manner, and individuals will be called by name to ask their questions. We kindly request everyone to please follow the format and limit themselves to 2 questions only focused on the results. Thank you for the cooperation. We will begin with Mr. Manojit Sahaj from Business Standard, please.
Good afternoon, sir. No, the first thing I wanted to know is that the profit after tax was down 10%. Can you hear me now?
Yes.
Yeah. So the first thing I would like to ask is that profit after tax for Q4 is down 10% year on year. Is it mainly because of the margin pressure because of the RBI rate cut, or there are other factors also?
See, from year on year, right?
Yeah.
The quarter Q4 and Q4 of FY25.
Yes.
There were some one-offs on the Q4 FY24, particularly on the provisioning write-backs and all. So obviously those write-backs were not there available in this. That is the main reason. Otherwise, the NII and all are performing well. There's no major reason for rate cut will play out going forward. I think there is some impact on the of the rate cut because 25 basis point rate cut was also there in the last quarter. And while we contained the cost of deposits and resources, there has been some impact of margins, but that will get reflected going forward. If you see, yield and advances and other things are stable.
Yeah, but NII growth is almost flat and the margin pressure. So going ahead, how long do you expect this margin pressure to continue?
See, the outlook is completely dependent on the rate cycle. And with the benign inflation scenario, what we have, we expect that there would be further rate cuts. And while the end rate cut by FY26 depends, how the policy rate cut will progress, we expect another 50 basis point rate cuts and starting with 25 basis point in the next MPC, which means there is definitely going to be some pressure on the margins. We are not able to put any number on the margin pressure, but pressure definitely is going to be there because some of the portfolio gets repriced immediately with the policy rate cut, while the deposits will take some time. And the lag is generally 12 to 18 months for the existing stock to get repriced, while the incremental deposits will get immediately repriced as we cut the rates on the deposits. So this lag impact will be having some margin pressure, while we do not have any guidance on what could be the pressure in the quantifiable terms.
Also, if you can throw some light on the future roadmap on loan growth, because RBI, if you see, have infused lots of liquidity. The main reason was transmission, but also to push credit growth, which has fallen very sharply. It was 10%. Yesterday the data came out. So do you think credit pickup will be there in FY26, and what is SBI's guidance for credit growth?
So our earlier guidance was 14 to 16%, if you remember, and we are moderating that to 12 to 13%. But system level credit growth probably would be 10 to 11%. The only upside which would be possible is that how quickly the tariff-related clarifications will come. Though Indian economy is broadly insulated, I don't say insulated, but less impacted by the tariffs overall, as I mentioned in my initial remarks also, our consumption-driven economy, I think, would be holding up well. Our exports to the US also are limited. But I think the uncertainty on tariffs is going to impact the overall economic scenario and investment scenario. So from that background, we believe that there will be some moderation in the credit growth rates.
Thank you. Thank you, sir.
Thank you. We'll take the next question from Siddhi from Reuters.
Hi, sir. Good afternoon. I had a follow-up question from what Mr. Manojit asked. My first question was on the tariff front itself. A few days ago, we saw HDFC Bank, the management of HDFC Bank, saying that corporates are kind of adopting a wait-and-watch approach given the tariff uncertainty. On SBI's book per se, how is the corporate loan growth faring? What is the pipeline? And how are corporates kind of reacting to this entire tariff uncertainty?
So while we have seen some moderation in the corporate credit growth, we are unable to link it directly to the tariff-related confusion. I think some of the impact, what we have seen in our corporate growth, rate being slightly moderated is a lot of prepayment and early payments have happened in the corporate book, either because of the deleveraging or because some equity raising which has happened at the company level. That has resulted in some moderation in the corporate growth. But I don't think there is any big change in the investment profile based on the tariff regime. So I think the more than the impact of tariffs, I think everybody is watching what could be the unfolding in the global environment. So the new investment announcements may not come immediately. But whatever commitments are there, we are seeing that nobody's going back on that.
Understood. What is your current pipeline, sir, outstanding corporate loan book pipeline? Sanctioned and disbursed?
We have about 1.7 sanctions yet to be disbursed and another 1.7 lakh on the pipeline basis, right? Around 3.4 lakh is our total pipeline.
Oh, 3.4.
Yeah.
Okay. So my next question is on yesterday's announcement, the Supreme Court kind of setting aside, the entire IBC resolution process. What is going to be SBI's stance now in this entire process? Is this something which is unheard of, something the first time that we've seen? Is there any approach that the bank is going to adopt in this particular case? And is there any estimation on how much of the, after liquidation, what's the haircut, etc., that's going to be taken?
So our standard reply to that is that we don't comment on these specific instances. So I would not be answering your second part of the question. But first part, definitely, we have just received the order. We will examine. And the legal firms which are advising the COC and the company would be examining, and then suitable measures will be taken. But beyond that, I request that, there is nothing more I will add to this answer. And please restrain from asking that question.
I request everyone to please stick to questions related to financial results only, please.
Next question is from Hamsini of Money Control.
Hi, sir. So this is also one of the first years where usually SBI gives guidance on growth, both on the loan front and on deposit front. Would you want to hazard a guess on what sort of expectations the bank is working on for FY26?
So as I mentioned, I think we have slightly revised our guidance. Our view, traditionally, if the nominal GDP is around 10%, SBI always outperformed the nominal GDP by 2 to 3%. We are still sticking to that. While our last year guidance was 14 to 16%, this year 12 to 13% seems to be a feasible number. The industry may slightly go less. That's what we normally observe, that SBI would be slightly better than industry going forward.
Is the base effect catching in your financials, sir? And I'm asking this question pertaining to the fact that Q4 numbers on a YOY basis have been slightly lower compared to what we saw last year. So is the base effect catching? And I have one more question as well. So, yeah.
No, sorry, what is your question on Q4?
Is the base effect catching on your financials?
Yeah, so there's definitely some base impact. Q4 FY24 was an exceptional quarter. But if you see that we still stuck to our ROA and ROE guidance. And the numbers, what you see here, if you do not consider the larger picture of stellar asset quality, I think you're missing something important here. At this scale, we have continuously guided you in terms of the asset quality. And we stuck to maintenance of asset quality, both in terms of credit costs, slippage ratios. More importantly, for the first time, you see two important ratios, the gross NPA ratio coming down below 2% and net NPA ratio below 0.5%. And with a loan book of 42 lakh crore plus, we believe that we have done a good job on the asset quality front. And the margins, as asked earlier, there would be some challenges going forward, and that also gets reflected in the other profitability parameters. But We still are confident that our guidance on the ROA 1% and ROE of more than 15% is still achievable through the cycles.
Perfect, sir. And my last question is, after a very long time, you've announced a fundraise of 25,000 crore. Does this also indicate, last time when you announced a similar fundraise program, we saw stake sales in some of your subsidiaries. Should we expect something like that in the annual, including that of Yes Bank? And you did mention that this is subject to market conditions and business requirements. But at what juncture do you believe this could possibly become more implementable in FY26, from a growth perspective?
As I mentioned, I think whatever capital plans we have is not a indispensable position in the sense that, there's a need for capital. We have adequate capital with this CRAR, what we have, we can support the growth almost of 8 lakh crore credit growth, which means that even without raising any additional capital, the growth will not be impacted. But we do believe that we need to augment our CET1 capital, and we have been making efforts. And every year we take the enabling provision from the board to raise the capital. The timing, as I mentioned, I think will be market oriented. In terms of subsidies or any other mode of raising capital, all options are open for us. But it all depends on what is emerging as we move forward. I'm not able to hazard a guess when will this happen and at what level it will happen.
Well, there you have it, the leadership of SBI commenting on the results, the Q4 FY25 results, beating the street on both net interest income as well as the standalone net profit. We'll, of course, have to see on Monday whether or not the street chooses to reward this performance in Q4 FY25 by SBI. But with that, it's a wrap on this special coverage of SBI earnings. But don't go anywhere. We get you the fine print of Kotak Mahindra Bank's Q4 earnings at 4:30 p.m.